Stablecoins are maybe the most important development in the modern history of finance. Bitcoin introduced secure digital payments to the world, but stablecoins made them usable on a global scale. So why are regulators worried? Should you be? Stick around to the end to find out and get a chance to win a Trezor One hardware wallet. Also, check out the link in the description to start securing your funds. First, some history. The very first stablecoin, BitShares, was developed in 2014 by the cryptocurrency heavyweights Dan Larimer of EOS and Charles Hoskinson of Cardano. Larimer and Hoskinson recognized that the volatility of Bitcoin and Ethereum made them impractical for everyday exchange of value, and BitShares was their attempt at a solution. At a high level, it was a crypto collateral-backed system that functions much the same way the Federal Reserve does. They issue debt against collateral, and then they issue the stable asset against that debt. But you could argue that crypto was just too young at the time. The price was too volatile, liquidity too low, and there were no price oracles to determine the fair value for a Bitcoin to execute margin calls in an effective manner. The project ultimately failed, but a notable member of the community, Rune Christensen, went on to found the MakerDAO, the issuer of the DAI stablecoin, which operates on much the same principles. But it's built on the Ethereum blockchain. It was also decentralized by nature, employing a community of individuals to decide collateralization ratios, issuance rates, risk tolerances, and so forth. DAI is still going strong today, and recently moved to fully divest its assets from the guiding foundation and fully decentralize itself. Now, around the same time, Tether was founded, but instead of being crypto collateralized, it claimed to hold one-to-one dollar reserves. Instead of being decentralized, Tether functioned more like a traditional bank, or money market fund, but more on them later. Digital stablecoins, one could argue, led to the explosion in DeFi we saw over the last few years. They gave people the ability to digitally hedge against the downward price movement of more volatile assets like Bitcoin and Ethereum, making it a lot easier to run an exchange outside the purview of regulatory authorities that allowed customers to cash out in stable assets they could spend. Even so, regulators didn't pay much attention until July 2019, when Facebook announced the Libra project. Now, to governments, banks, and regulators, Libra was terrifying. Up to that point, stablecoins had all been pegged to the US dollar, the world's reserve currency. But Libra was proposing something new. They were proposing pegging the value to a basket of international currencies to be determined by the international consortium. Now, think about that for a second. Facebook, a platform with close to 3 billion users worldwide, was trying to introduce a native peer-to-peer currency that wouldn't be denominated in dollars. The effect on the global psyche would have been drastic. It might have broken the dollar's psychological hold on global value and undermined one of the key pillars of state sovereignty. Fun little note, it also looks a lot like a one world currency predicted in Revelations that ushers in the biblical apocalypse and the rise of the Antichrist.
Release the evil.
So, that's fun. Policymakers, bankers, and politicians worldwide responded with a collective "you, Mark Zuckerberg," which is honestly pretty fun to say. Just remember to apologize to your phone afterwards. Sorry, Mark. That's when the regulatory fight started. Facebook quickly changed course as members of the Libra Foundation like PayPal, Square, Visa, and MasterCard backed out. This ushered in the era of heightened scrutiny that we're living in today. The New York state regulators went after Tether, revealing in the process that they weren't actually backed one-to-one by dollar reserves. In fact, they only hold 2.8% of their reserves in cash, while the majority of their holdings are in unsecured short-term debt. This finding led Jerome Powell to call Tether an unregulated money market fund that risks systemic collapse in a recent interview before Congress.
Thank you. I want to switch to stable coins and pick up where Mr. McHenry left off, specifically on Tether, particularly the amount backed by commercial paper as opposed to US dollars, which is what they originally said. Do you share these concerns?
Yes. Commercial paper, or short-term overnight obligations, but most of the time they're very liquid, it's all good. But in both of the last two financial, during the acute phase of the crisis, the market just disappears, and that's when people will want their money.
And as much as I hate to admit it, he's right. If the commercial real estate sector or stock market crash, those debts may be called in, and too many defaults could cause Tether, which has a $60 billion market cap, to lose its dollar peg, which would have wide-ranging implications across centralized and decentralized finance platforms. We could see a market sell-off just to recoup losses. That could cascade into the wider economy, making the crisis worse. Then the Fed would have to decide whether or not they wanted to bail out the crypto industry, which I would not bet on.
Please disperse! Nothing to see here, please!
Stablecoins are undoubtedly one of the most revolutionary technologies developed in the 21st century. But
their misapplication could present risk to all of us invested.
Remember to give this video a like and subscribe. If you subscribe and comment "I subscribe," then you'll be entered in our drawing for a Tracer 1 hardware wallet. Thanks for watching. Try to stay safe out there.